Welcome to another video from Creativo Solutions. You're actually watching the podcast series. The audio comes from live content recorded from live classes. I hope this content will help you learn something that will add value. If you have any comments or questions, post them below and consider subscribing to this channel. The audio contained here will be covering accounts receivable or debtors and accounts payable or creditors.
Perfect. So let's now look at the first bit. So if I'm looking at accounts receivable, the first word that should pop into our minds is debtors. Debtors have a very specific relationship with the business, right? They arise when we sell on credit. Only when I sell on credit. You don't call your customers who you sell to for cash your debtors. You only call the people who buy from you on credit your debtors because you've sold to them. So there's the first bit, credit sales. Lay-by is actually a form of cash purchase. Yeah, it's more like a pay now and you'll receive later, or pay a portion every month and then you'll get it at the end. Yeah, so that's not debtors. There's no credit there. Okay. All right, so if I'm focusing on a credit sale is going to have what debits and credits? Basics. Do you still remember? Fine. What's the income? Yes, there we go. We've got one bit. Happy with that bit. What else? Debit the bank. No cash. Debit the inventory. No inventory.
Credit sale.
Ooh. Yes. Okay.
Right there, guys.
Debit debtors, why? Asset increase. Basics. You know you're creating them, right? You didn't have debtors before you sold. When I sell, I create them. Can there be VAT here?
Yeah. Yes.
Of course. What VAT? Output VAT. Do you remember what it is?
Output is a liability.
Correct. Okay, there we go. We've got it. Output VAT, liability increase. Now you've got the first bit. We can highlight that. That's the credit sale. If I buy goods, I'm going to have a debit for debtors, credit for sales, and VAT if it's applicable. Okay, taxes. Will there be any other transaction there? Very good. Okay, so you guys actually told us why perpetual is so important. Okay, because you need to monitor and keep track of stock. So we will have a debit for cost of sales. And we will have a credit for inventory. Asset decrease. Close brackets. And that's what we've got there.
Are you having cost of sale because it's perpetual?
Cost of sale because it's perpetual? Yes. I'm going to put the heading just now. How do you identify the question? Has to either state that or you'll see clues in the question. So if you see the word cost of sales, it's a clue. Okay, this is for perpetual. Only for perpetual. Just to contrast that, periodic, no other cost of sales. Okay, you'll never ever have it. It'll literally just be debit, debtors, credit, sales, credit, output, full stop. That's it, the end. Right, so now you've described one transaction. What else can you have with your debtors? Good. Okay, so there's the sale, then we have the return. So what would the return have as a accounting entry? Yes. Okay, the opposite of what you had here for the sale. So before I increase the debtors, now I'll decrease them. Before I increase the sales, now I'll decrease it. Before I increase the output VAT, now I'll decrease it. So it's literally the complete opposite of what you had over there. Okay, so we're going to debit the output VAT, which is a liability that's decreasing, and we'll debit the sales returns, which is an expense that's increasing. What system am I using here? Perpetual. Do I need to reverse out the cost of sales?
Yes.
Definitely. Just need to correct this here just to make it accurate. Decrease. Debtors decrease. Now that's right. Right, so debit the output VAT, debit the sales returns, debit the credit the debtors, asset decrease. That's the sales return. I still need to process this. So now I'm going to have to process the reversal. So I'll credit cost of sales, expense decrease, and I'll debit inventory assets increase. Is that okay? Make sense? You've reversed out the sale, so that means you got the stock back because it's a sale return. Only if it's a sale return. So you must have physically received the stock back in order to process this. Debit inventory asset increase, credit cost of sales, expense decrease. What will you have for periodic? What VAT? The VAT is there. Yeah, we reversed out the VAT. Do you see that? Okay.
And can you start a question? You know what I just want to know.
Yeah, ask. Questions are good.
You know with returning the stock, what if it's something that the business can't sell again? Like maybe it was broken or doesn't work?
Well, then that stock will stay at the business until they throw it away. If it's food, then that's wastage. Then you'll write it off. Okay, it'll be an expense that will be classified as wastage, right? Or you might return it back to your supplier, possibly, maybe, who knows?
For the returns, they would rather use a different account than inventory versus credits. I mean, that is allowed.
Okay, so you want to use a different name here?
No, I was asking in an exam question, for example, would they use an account different from that?
Okay, you're talking about journals. You could use a sales returns journal or a debtors allowances journal. Both would be fine. Doesn't matter what you call the journal, but the return would always be that. Okay, so yeah. Your textbook, I think, refers to it as debtors allowances. Doesn't matter. Sales returns makes more sense because it's a sale return. Okay, but doesn't matter. I'm not going to mind how you refer to it in terms of a return. Okay. Periodic, what will you have? That, and that's it. Do you agree? No cost of sales. Why? Because the items that come back will now be included in the stock take when you count all your inventory. Okay, because if you count all your stock, you'll see, oh, okay, I've got a bit more because of the returns. Okay, but you wouldn't have known where it came from. It's just not any other stock that you would have had. Okay, see, that's another thing we could have added to that list. Okay, periodic, right? There's no need to identify stock that's returned or stock that's bought. Stock is stock. Doesn't matter what it is. Right, so nothing there either. No cost of sales again. Okay. Right, maybe just to add the journals as well here. Sales journal / debtors journal. Just to be more comprehensive. Right, so when we spoke about the credit sale, that's the journal. Sales journal, debtors journal, depending on what you call it. Sales returns journal, or debtors allowances, depending on what you call it. Those are two. What else can we have with our debtors? Other transactions that will affect the debtors. Okay, when do discounts apply? Not at the time of the sale. When they settle the account, yes, that's better. Okay.
You can give somebody a discount, can't you?
That's a trade discount if you give it to them when they buy. Okay. You're talking about the discount that they allow or receive. Which one will I have here? Okay, you allow discounts to your debtors, correct. So next group of transaction, the cash receipt, which is the collection. So if I sell something on credit, at some point in time in the future, you would expect to collect the outstanding amount. Hopefully. Doesn't always happen. Okay, we'll come back to Chumani's note about bad debts. Okay, remember, bad debt is when you write off debtors that don't pay. That's a possibility. Okay, so do you guys agree a cash receipt will affect which accounts? How will it affect bank? There you go, you've got it. Will I have that here?
No.
Why not? Okay, exactly. There's no buying or selling. It's just a receipt of cash. There's no VAT. There will never be VAT here. Okay, it's literally just a receipt. I'm receiving money. I'm reducing my debtors. Perfect. Where will the discount come? The discount will come here, right?
But it's the debit account. But that will be.
Discount allowed, discount received.
Discount allowed.
Okay, so settlement discounts, settlement discount allowed potentially. And if that's the case, what am I going to have? A debit or a credit? Credit.
Wouldn't it be an expense?
So if it's an expense, the debit. There we go. Okay, so this will still apply. This will still apply, but debit the discount allowed expense increase. Right, that's the new bit that we need to identify there. That's only applicable to debtors. You won't have any other discount with your debtors other than discount allowed. But it's not always there. It depends on whether you've given a discount to your debtors or not. That's something to consider there. Is that all right? Great. What else can we have? Bad debt. Let's discuss that one. You spoke about it earlier. Bad debt is what type of account to the business? Liability, no. Expense, yes. So if it's an expense, think about it. What definition does it meet? Outflow of benefits. If someone doesn't pay you, do you lose something or do you gain something? You lose something. It's not an obligation. I'm not obligated to pay them because they didn't pay me. Do you agree? Okay, bad debt is you losing something. Does that make sense? Okay, so the only definition it meets is the definition for an expense. Bad debt / credit, losses, expense, increase. There's the first bit. What are you going to credit? Not inventory, the debtors, correct. Right, because you're writing them off. Think about it logically. Am I going to show more debtors or less debtors? Less debtors. Debtors is an asset, debtors must decrease, debtors will be credited. That answers the question. What else, guys? There's still another account. Something else that you haven't considered yet. Good. Okay, nice. You guys got it. So, how is interest going to affect the business? It will increase the debtors, correct? So what are we going to do? Debit the debtors. What else? Yes. Okay, so you said we're going to charge interest. So interest income on overdue accounts. If I have an overdue account, I'm going to charge them interest because it's outstanding. And the longer it's outstanding, the more interest you'll charge, potentially. So what's going to happen to my debtors? It's going to go up. If it goes up, is that good or bad? It's good for the business because you've got more that you can collect. It's bad if they don't pay. Right, so credit the interest income. And now you've got the other half. Now you've got the credits. And that's your debtors. That's your accounts receivable. Now let's change focus and let's discuss the other half of the relationship here. Oh, let's just put in the journals here. I put in journals for that one. I didn't put in journals for the last two. Which journal would this go to? Why general? You're right. Good. It's other. It's not a receipt. It's not a payment. It's not cash. It's not credit. Okay. Where would this go? No, not the debtor's journal. Not the cash. There's no cash there. Hey? It's just the interest you're charging. Yes. So again, general journal.
But why wouldn't
Why wouldn't?
you put it in the debtors journal?
Well, you could if you had a column for interest income. Right, but then it's not really a sales journal, it'll be a debtor's journal because the debtor's journal would also have other transactions like interest. Possibly. Okay, so you're not wrong, okay, but you just needed to specify that you would have to account for it separately. Okay, it wouldn't be a sale, it'll be interest. Right, that's possible. So you could have a separate column for it, or you could have it in sundry. That's also fine. Okay. Right, so let's change focus. You guys have completed that bit. Accounts payable. First person that comes to mind? Good, the opposite. Creditors arise when what happens? Good. Okay, credit purchases. All right, so give me the accounts that are going to be affected.
So your credit
Credit what? Credit purchases. Credit what?
you credit the liability.
Okay, credit the liability, which is the creditors. Happy with that. So debit, credit. What else?
Input back.
Yes, you would. What is it?
It's an asset and it's increasing.
Okay. Agreed. There will be VAT. Okay, tax. So debit the input VAT. Asset increase. What else?
Depends what you're buying on credit.
Well, true. So if we're just focusing on the inventory story, because that's what we're carrying through, if I'm buying inventory, it's inventory for which system?
It's inventory for perpetual.
There we go. See, we need to be specific again. So again, I'm going to have to take that note because now it affects the purchases because we call stock something different when I use perpetual or periodic. So this is going to be inventory. Will you have the same thing for periodic? No. The only thing that will differ is this. Purchases. Expense increase. Okay. Now you've got both. You've got the perpetual and you've got the periodic. And this was for a purchase. Okay, you've bought. You've bought something on credit. What else can happen? Good. So we had a return earlier when we had a credit sale. Can you return goods to your supplier? Of course you can. What is going to happen here? You're going to reverse what? Tell me.
So that you'll debit the creditor.
Debit the creditor. You're right. Because you're reversing out the liability. That's correct. So, purchases returns. Debit the creditor's liability decrease. What else? Good. Credit the inventory. Notice it's inventory because it's perpetual, correct? And the same thing for? Yes, we need to reverse it out. Asset decrease. Right, and that's the return. Would that apply to periodic? Yes, except yes, purchases instead of inventory. So debit creditors, credit purchases, returns. Let's put that in bold. Purchases, returns. What is it? It's an expense. Income, actually. It's the opposite of purchases. Increase. And there you go. Now you've got the return. What else? What else? You can pay. Good. Cash payment. Right, so if it's a payment, what's going to happen? Creditors are going to decrease. What's going to happen to my bank? Decrease. Correct. Okay, so cash payments. The cash payments will decrease the creditors, so we'll definitely have that. And credit for the bank asset decrease. You're making a payment. You're decreasing the bank. Will there be VAT? No. Will that be the same for periodic? Yes. It makes no difference, okay, because it's the payment, not a purchase or a return. So you wouldn't have anything different for the two different systems. Right, what else? You mentioned? What discount? Correct. Okay, so discount received. Will you ever have anything different? No. Remember, discount received is specific to a creditor. Make sense? Great. Let's just show the discounts. What balance will the discount have? Debit or credit? Debit or credit? What is it, guys? Yes, discount received is income. So, debit or credit? You'll have a credit. Discount received income increase. Good. Why is the bank decreasing? Because you're paying. Right, maybe we should add some numbers here just to make it make more sense. I'm going to go up to the top here. Right, do you agree if I've got 100 that I'm going to be paying off? 100 is going to be paid off and you're going to allow a discount of 10%. Okay, let's use that. Okay, so if I'm using 10%, how much do we actually receive? 95. The discount is 5 and the debtors will go down by 100, just to show that. Okay, because it's a split. You're splitting the total in two. One bit is what you actually pay, the other bit is a benefit that you give them as your debtor. Okay, which is actually an outflow in your books because it's an expense. You didn't get everything that you were supposed to from your outstanding debtor. Does that make sense? Okay. What else? What happens if you're failing to pay? That's a good question. Can you have bad debt for a creditor?
Yeah, because you can what you call bankruptcy, file bankruptcy.
All right, but then whose books are we looking at? Our books. Okay, do you show bad debts for your business? Okay, because what is that? That's your refusal to pay. Okay, So you don't show your own refusal to pay in your books, because that's what you're actually saying. Okay, I'm not going to pay, I won't pay, so I'll put bad debts income there. No. Okay. Right, you can't show that. Right, so so you'll never account for bad debts for creditors, only for debtors. So which is more difficult? Debtors, slightly, because you've got bad debts. Will you have interest here? Yes. Okay, you can be charged interest on your overdue accounts. That's possible. So that's the last bit. Interest, what? Expense or income? Good. Okay, that comes back to our basics. Liabilities generally create expenses. Okay, liabilities incur interest. That's why we don't like them. Okay. Give me the workings. Debit and credit what? You would. Correct. Interest expenses or expense. And yes, you would. Creditors liability increase. Perfect. Right, so now you've got the interest working for the debit and the credit for this particular account. Okay, you guys happy with that? Right, so let's test and see, are you capable of identifying what's happening in the examples in your book? Okay, so I just want to quickly put the journals here before we continue. Which journal would this go to? Purchasers journal / creditors journal. Which journal would this go to? Purchasers returns journal or creditors allowances journal? This one, easy, cash payments journal, it's a payment. And where would that go? Yes, other general journal. Perfect. Okay, so now we've completed our summary. We can save that.
That concludes the audio for this session. Thank you for listening. Consider subscribing to the channel and hit the thumbs up button if you like the video, and we'll keep creating more to help you.